Hi there, welcome back. You're watching The Money Show on ET Now with me, Kanishka Sarkar. And in this segment, we'll take all your real-life financial doubts with our experts so you can make smarter, more confident investment decisions. And today, we have lined up some very powerful viewer queries from building a 5 crore rupees corpus to EPF withdrawals to aggressive SIP portfolios targeting crores over the next decade. And Nisreen is with us. Great to have you back, Nisreen. Well, let's get started then. Our first query is coming from Rushikesh, who's 27. He's been aggressively investing and wants to hit that 5 crore rupees target in 15 years. His SIPs of 40,000, strong start currently. He currently invests in Parag Parikh Flexi Cap, Motilal Oswal Mid Cap and Quant Small Cap with a 3 lakh portfolio and 40,000 rupees monthly SIPs. So what would you suggest is the fund mix right now, and how close is he getting to that 5 crore rupees target?
So firstly, let me begin by congratulating Rishikesh. He's 27 years old and he's already started investing a sizable amount for his age, 40,000 rupees into SIPs. He's also got a portfolio value of 3 lakh rupees. So that's really very good and very encouraging to other young viewers and also to suggest this path to their children. Now, as far as the current portfolio goes, your flexi cap is about 30%. Your mid cap is about 35%, and your small cap is also 35%. So I'm sure that knowingly you've taken a high risk, high growth kind of a portfolio, which is perfect for a 27-year-old who's investing for at least a 15-year period, because 70% is in the small and mid cap category. Now, you should, there's a suggestion that you could add a large cap fund for the sake of stability, because, when there's a downside possibility, your large caps will kind of cut that risk and give you some amount of stability and balance to your portfolio. So what you could do is you could add maybe HDFC Nifty 50 index fund or the UTI Nifty 50 index fund to your portfolio. So what your suggested allocation could be is a Parag Parikh Flexi Cap about 30%, mid cap is Motilal Oswal Mid Cap 30%, small cap could be the Quant Small Cap 25%, and a large cap index fund you could take either of the two mentioned earlier to the extent of 15%. So here, you will be able to add stability and not sacrifice the growth that you intend to have. Now, will you reach 5 crores in 15 years? So that's, the target corpus that you have set yourself. Now, if you take into account 40,000 SIP and the 3 lakhs current portfolio that you have, and an assumed compounded annualized growth rate of 12% over the 15 years, your future value would be about, say, 2 crore rupees. So, there is a bit of a gap between your expectation and your actual corpus that could arise if your compounded annualized growth rate is 12% for the next 15 years. So you have a couple of options which I'll discuss with you. The first option is that you can add more SIP, and that could be to the extent of, say, another 1,10,000 or 15,000 rupees, which seems a bit improbable for any investor. Your second option is a step-up SIP. So if you increase your SIP by 20% every year, from 40,000 rupees you start now, and every year you increase by, say, 8,000 rupees for the next 15 years, then your 5 crore rupees target corpus is possibly achievable. And this could be the best possible way for you to achieve your, goal. And the third option is that you can extend the time frame. So if you do a 40,000 SIP and maybe a 10% step up, which is 4,000 rupees every year, but you extend your time from 15 years to, say, about 21 years, then also your 5 crore corpus is achievable. So, you have all these options available to you. Increase the SIP amount, do the step up SIP, and, extend your time frame. So, whatever works for you, and all the very best in your investing journey.
Let's see, those are the 3 options that he could look at. Rishikesh, hope we've answered your query, and good luck on building that 5 crore rupees corpus. And many congratulations on being so aggressive with your SIP so early on in life. Let's move on and get to our next viewer, who is S. Srivastav. He's from Gujarat. He is 58, recently retired, and wants clarity on where to park his EPF corpus. He wants to know whether he should withdraw his EPF corpus and invest in an RBI floating rate bond, or should he leave the money in EPF for the next 3 years again? So his regular expenses, they are already supported through his equity funds and real estate. That's what he has told us. So Nisreen, what do you think? What's a safer and better option for someone who doesn't need money for day-to-day living? Continue EPF or shift to an RBI floating rate bond?
Sure. So Srivastava ji has already done his asset allocation because you've got your real estate, you have equity mutual funds, and now your query is only on the fixed income part, which is your EPF. So congratulations on that. I mean, you're probably you retired recently, and I'm sure you've had a great innings at work, and you planned yourself really meticulously. So very good. Congrats for that. So basically, the advantages of investing in an employee provident fund post retirement is that you get a higher interest rate for a fixed income products. So historically, it's between 8.25 to 8.5% per year. This would obviously be guaranteed in tax-free returns, which is a very nice and a fantastic situation to be in India. It's very rare to have this kind of a situation to be in, and you can legally keep your EPF till age 58 for another 3 more years. So you can you still have time on your side. The disadvantage could be that after retirement, EPF interest remains tax-free only for those 3 years. After that, the interest will start becoming, taxable for you. And the EPFO might have a delayed interest, crediting sometimes. So not the payment, only the crediting, could be delayed. So that should not affect your cash flow. But since you are already protected by your equity mutual funds and your real estate for your regular cash flow management, this may not be too much of a disadvantage for you. So the question is now, should you move your money to RBI floating rate bonds? So the advantage is that it's obviously a Government of India bond, and so it's 100% safe. The tenure is 7 years for the RBI floating rate bond. The interest is every 6 months, and it's typically NSE rate plus 0.35%. So that the interest is reset every 6 months. Currently, it's about 8.05%, but this is taxable. Okay, so that's the disadvantage for you. And another disadvantage could be that this interest is fully taxable from your side, and there's a 7-year lock-in, so you cannot exit until you become 70 plus. So if you decide to do that, then there will be a lock-in of say at least 7 years, and this money will not be available to you. And plus, if the interest rate is reset, which is very possible right now, it could be even lower than what you are seeing at this point. So after tax, also the real return drops. So if you consider the tax slab that you are in, if you are in the lower income tax slab post retirement, this could be still a favorable option. But if you are in the higher income tax bracket and the interest is taxable on the RBI floating bonds, then it may not be a very attractive option for you, because you have to also consider inflation. Currently the inflation is low, but on an average, we see the inflation is about 5 to 6%. So during your retirement years, you don't want to be stuck with a real return, which is say perhaps lower than inflation, because your purchasing power will be greatly affected to that extent. So please ensure that you check either the taxation as well as the inflation figures. So typically after 3 years of investing in EPF at age 61, maybe you can consider 40% investment in senior savings citizen schemes, which is 8.2% taxable, 40% in maybe the RBI floating rate bonds, if you still want safety, which is a primary concern for you, and 20% in short duration debt funds. This could be for, your liquidity and flexibility purposes. So this is what you should consider post 3 years of investing in employee provident fund, and after you complete the period that you have decided.
Fantastic questions today and great insights from Nisreen. Thank you so much. On that note, we'll let you go. All right,
Thank you so
now
much.
if you want your portfolio reviewed on the show, just send us your age, goal, SIPs and timeline, and we'll feature you next. Thanks for watching The Money Show today. I'm Kanishka Sarkar, and I'll take your leave now, but you stay invested and keep watching ET Now.